Hi, I'm Greg Welborn with First Financial Consulting. And I want to talk a little bit today about what makes First Financial Consulting different. You see, not all financial planning processes are the same. There are differences in how holistic they are. There are differences in how detailed they are, and therefore there are differences in how helpful they are. I think the essence of the First Financial difference is found in both the roadmap that our plans provide and the confidence that they therefore give our clients that they are going to be able to achieve their dreams. So I want to walk through a typical planning case and show you what that difference looks like. We start out by having an in-depth conversation about what the client's goals are. See, the planning process, everything that we're going to look at, from taxes to investments, insurance, everything, has to relate to what the goals are. In this particular case, I've grabbed what obviously is an older case. We started working with this client in May of 2009. And I've done that because I want to take you through what did the planning process look like, what conclusions did we end up with, then how have we helped the client monitor progress along that path, and then at the end, today, what new challenges have arisen and what are we going to do with those? So I'm not going to go line by line here. I don't want to bore you, but as you can see on the screen, we've identified the basis for the planning process. We believe in using a cash basis. You can only pay your expenses and meet your requirements, your needs out of cash flow. We're going to identify what the goals are. In this particular instance, not surprisingly, the client wants to have the flexibility to retire as soon as possible. He was mid-50s, wants to be able to just cut it off, leave, and move and start enjoying that next phase of life. That means, though, that he has to make a decision about how is he going to use his employer's retirement plan, because being earlier than age 59 and a half, he couldn't just tap into the IRS without there being significant penalties or restrictions. So there's a gap. This was the key problem for this client, is what's this gap between about age 55 and age 59 and a half when he can finally start using the retirement plans, the IRAs, 401ks, etc. He also wanted to look at what happens if he loses Social Security. His concern was that it wasn't going to be there, and since he's retiring at a young age, if that gets cut off, how does that impact his success? Finally, we want to take a look at some of the dream items. That's important in any plan. This is not just about determining what your living standard is and then moving into retirement and only continuing to live the way you are. You've worked hard to get to this point. Most people have dreams, goals, things they want to do in retirement that are different than what they're doing right now before retirement. In this particular client's case, we wanted to drop in getting a sailboat, very important to him. And since he loves the water and the ocean, wanted to do this down in San Diego. Could he also get a little townhome in San Diego so that he would have a place to stay when he was not on the boat? Okay. Finally, after we establish whether or not this is going to work, we're going to stress test a little bit this plan. What happens if there's a long-term care need that comes late in life? Does he need long-term care insurance? Most importantly, since he does have kids, does have relatives that he would want to leave a legacy, we want to make sure that his plan, his dreams can be achieved, but at the same time, that he's going to preserve the underlying investment value. As we go through with inflation, that value has to keep up with inflation. And then we're going to develop an investment plan to tell him how to accomplish all of this. Assuming this works, obviously, but if it does, how do you actually invest the money so that you know the plan's been reinforced, the plan's going to be successful? And then we look at how we implement that. Fairly straightforward. Many of you may relate to this. Your circumstances may be a bit different, but the bottom line is you've got goals for the near term, the intermediate term, the long term. You've got dreams, things that you put on your bucket list. You want to make sure that all of them are going to be achieved. We then start with a fairly detailed analysis and review of what the current position is. We really need to understand all of the assets, all of the liabilities, any particular aspects of them. So we kind of put in our comments section, this is what we have to focus on. This is an important element. We've received from the client reams of data. We have a wish list that we kind of send out and say, we need to see this and this and this and this and this and this. And, it's a pretty thick ream of paper. We're trying to distill that down essentially into one 8.5 by 11, where we're saying, these are your key assets. These are the values we see. There's the debts against them. These are the significant parts of that. Break them into the components that make sense. What are regular taxable accounts versus what are retirement accounts, life insurance, real estate, etc. We're also, though, paying attention to what's the income coming in. What's the composition of your income, your salary, dividends, capital gains, restricted stock units, stock options, RSUs, fill in the blank. And then what's going out the door? Because you've got to live. And it's not just looking at one big living expense number, because not all living expenses are going to grow or change at the same rate at the same time. So we want to isolate the ones that are important, that are significant to look at. And then, yeah, there'll be a lump sum, as you see on the page right now. We've kind of looked at what's the mortgage and the rent. What are property taxes? Those are going to grow at different rates than the general level of inflation in this country. We also take a look at medical expenses, health insurance, one sort or another, vacation travel, which was big for him, charitable gifts that he wants to make. And then we have some of the elements that relate to what are the contributions that he's been making into his particular employer's savings plans and pension plans, etc. And then, as I mentioned, there is the catch-all of all other expenses. We don't care about the dining out. We don't care about dry cleaning. We don't care about the gas. I mean, those are important in a certain sense, but that would get too detailed to be trying to project forward. So we're going to collapse those into one line item because we've identified the ones that are key. So now we've got understanding of the client's current situation, assets, liabilities, special components, income coming in, expenses that are going out. We have some additional items to consider in this case. What was the composition of income tax? Federal, state, Social Security, Medicare, state disability, etc. What are the pension issues? What does that pension payment look like if he takes that option as opposed to taking the lump sum option? We ultimately come up with that understanding, pretty detailed, but now we need to project it forward because we need to take that and go forward into the future over all the years that the client and we, the advisor, feel are reasonable. So we're not just going to take it up to some retirement age. We have to take it up to and through retirement to a point in time where he realizes that if I've got money left over at a certain limit level at that time, the odds are if I outlive that, am I going to be fine? In this case, he decided on age 92. And you'll notice there are just select columns here. I'm not trying to go through all the pages, but we looked at the current year. Remember, this is an older plan, so we're starting at 2009. So we use 2008 as our base year, imposing upon it what's going on in 2009 and then 10, retirement at age 60, or not retirement, sorry, but that's the point when you can start tapping into the IRA without penalties. And then we take it all the way up to 92. I'll go over results in a little bit, but you'll notice here what we've done is we've identified the key assets. So we're taking a look at a surplus investment. That's the investment account for where everything kind of goes into or comes out of based on cash flow surplus or deficits in any given year. He needed to have a conservative account, one for emergencies, so we've got that. Then we have the IRAs and the 401ks, we've got the pension plan. And then we've got the residence, the net equity, and if there were any rental properties, he was considering that at one point, we throw that in. For each of these assets now, we have at the top of the page, we've made an assumption. What's it going to grow at? What's it going to generate in terms of total earnings? We've also taken a look at the average tax rate, 401k contribution. As you can see, these assumptions are pretty detailed, focusing on each of the asset classes, categories that we're looking at in this client's particular plan. From that, we can make reasonable projections about what are the earnings, but more importantly, what are the cash flows that can come from each of these assets. Remember, the basis for our financial planning is cash flow. It's one thing to project earnings, for example, earnings inside a 401k. You can earn quite a bit in a 401k, but if you can't tap into that and actually withdraw cash without a penalty, you can't buy a gallon of milk, you can't pay the mortgage. So we're projecting both the asset level, the earnings level, but also then the cash flow in, cash flow out. We push this through all the years, and you'll note there are a couple of areas which are highlighted in kind of a soft orange, light tan color. Those are when the changes are being made. We want to focus on certain years, certain cash flow items or asset items where a change is happening. So in this particular situation, the first one that we see on the page, the pension plan goes for $552,000 to zero in the year 2008, transitioning to 2009. That's not because the pension plan is lost. That's because in this instance, what we assumed was he's going to convert it and he's going to actually take it down as a stream of payments, or that he was going to put it into his IRA. So as you see on the page right now, his IRA goes from being $1.3 million in 2008 to being $2 million in 2009, right here. And that's because what happened is he took the pension plan and rolled it over into the IRA. So we're just highlighting what those changes are. Bottom line is we come down and we've got a net cash flow surplus or a net cash flow deficit. And the basic assumption here is if you've got a surplus, you're not sticking it under the mattress. You're going to invest it. It goes back into our taxable investment account and grows. So on the other hand, if you've got a deficit, you're not going to float more credit card debt and get into debt wildly. You're going to draw down on that surplus investment account or wherever else from IRAs, pensions, et cetera, that might make sense from a tax perspective. So we're using that cash surplus line to tell us what's growing or what's not growing and having to be drawn down on. It's an extremely important item. It's one of the most important parts of any plan is to get that cash flow correct, because we're going to push it forward here to age 92, garbage in, garbage out. That's why we spent so much time in understanding the current financial position, to really know in a reasonable year, can't predict down to the penny, but in a reasonable year, really what is that cash flow and what's going to happen to it in the future. Scenarios that we considered in this particular client's situation. The current situation that we looked at was retire right away. This was June, so we're saying, great, you can retire at the end of the month. You're going to start off, have half a year, and then go into future years. You're going to have $2.4 million in your investment assets. Now, they need to grow to keep pace with inflation to $7.3 million. I know that sounds like a big number, but that literally is just to keep pace with inflation. What does $2.4 million back in 2009, what does that buy in terms of gas, dry cleaning, restaurants, etc.? Go all the way out to age 92. What do you need to have in the piggy bank that allows you to buy the same amount of gas, milk, dry cleaning, etc.? Well, 2.4 needs to become 7.3. So that's kind of our benchmark. In this particular instance, as we projected, the client would take that pension, roll it over into his 401k, and then just start drawing down where we could without incurring the penalties for early withdrawals. He was going to have $22 million at age 92. Obviously, more than enough. So you think, great, case closed, move on. Not so fast. The key problem in this particular client situation is because that he was not yet then 59.5, because he would be relying heavily on the regular investment account, not on the IRA. He was going to run out of that account, and he would be forced to, at age 59, dip into the IRA at larger amounts than otherwise might be the case. And the more you withdraw from the IRA, the larger is going to be the tax burden. So in this case, yeah, he could have made it, but the taxes were going to be absolutely horrendous. So now we start doing some revisions. Yes, you can retire, but let's fine-tune that. And remember, at this point in time, we're just retiring with living expenses as they are. So the revised model he wanted us to look at. Let's take that pension payment and take it as an annuity rather than lump sum. So now the pension company is going to just pay a certain amount each month, a quarter, a year, however he decides to take it. Clearly, he can still retire and meet his goals. But he would also be able to keep more of the taxable investment account and therefore rely less on the IRA distributions, keep them to literally the required minimum distributions. That minimizes the taxes. So now we've got a better solution for his retirement. Now we're going to start throwing in some other things. We looked at, I'm not going to take you line by line again, but we're going to look at how about long-term care costs? What happens if you do incur a need later in life? What's that going to do to this otherwise great plan? What happens if you do lose Social Security? That's another option that we ran. Then he asked us to take a look at what happens if his mother runs out of money and he has to care for her medical costs. We threw that in. And then the dream. What happens if we throw in the purchase of the sailboat? What throw in the purchase of the townhome? Of course, we assumed it would be conventional bank financing for both. Each of those were individual runs. Let's isolate this variable, take a look at what happens here. Okay, go back to the base, change another variable. In each case, we're trying to see what's the sensitivity of the overall plan, the overall success, to the change that's important to consider or that the client specifically is asking us to consider in the case of the dreams. The last one we ran is let's throw it all in, put them all in together. So now we're going to use the pension payment as an annuity, and we're going to include in all of the other items and the wish list. So he's going to care for his mom. We're going to eliminate Social Security. We're going to take into consideration long-term care insurance and the boat and also the townhome. What does that look like? We put it all together, and then we graph out what those asset values are going to look like. The top line, the orange line, is scenario number 1. Theoretically, it's the best in terms of just overall assets. But life is not just about accomplishing growing to $1 gazillion. It's about enjoying what you've worked long and hard for. The clients that we work with best are not the ones that are saying, I want to become a super billionaire at the expense of enjoying life, at the expense of my kids. I don't care about a legacy. I just want to have the ego claim of I want $1 billion, whatever that magic, large, huge number is. It's not what life is about. Clients that we work with best have realistic goals. They've worked hard. They want to enjoy something, and they want to figure out how do we do that? And how do we balance? Yes, I want to leave a legacy for the kids. Not necessarily at 100% expense to me, but not at 0 expense to me. I want to use some of those assets. Know that I won't run out of assets, and know that the kids, grandkids, will enjoy something. In this case, the last run, that run that threw in a lot of this, ends up being, as you can see, it's not necessarily the worst, okay? But it's not the best. It's the brown line right about here in the middle, okay? So he's choosing something that might appear to be suboptimal. Well, I shouldn't say not optimal. What he chose was optimal for who he is and what he wanted. But this was something that was not as good as the best, clearly not as bad as the worst, but it fit who he was, what he wanted to do with his family. That becomes the plan. Now we've got a roadmap, a plan. We know there's going to be a successful outcome. Case over? Client relationship ended? No. Because in order to make sure that this works, remember, there was an assumption. I'm just going to go back a couple pages to show you. So we are assuming that there was going to be an 8% average annual rate of return in the investment accounts. This plan works with that. So when we made our recommendations, you can retire, you can take the annuity payment, you have confidence that you can withstand some of the negative events, the negative years, you can enjoy the wish list, et cetera, et cetera. But you got to actually put together an investment structure and monitor it to make sure that you're going to achieve the rate of return that's assumed in the plan that allows you to enjoy the life that you. We're working with this client and have been from 2009 forward to figure out what's going on. You'll notice that this is a performance report all the way through June of 2025. It's a lot of years. And what we're doing is we're plotting and monitoring and managing that rate of return, that account return net of all fees and expenses against what was the goal. We called it the IPS target, investment policy statement. That literally is a document that we put together with our clients. It says this is the policy statement. We're going to allocate the assets in this way because we believe this way, this allocation will give you the rate of return that you want and within the boundary of volatility that you want so that you're going to be comfortable and you won't bail when times get tough. Well, if that's something we put forward as achievable when the client says, yes, I want to do it, we should be willing to hold ourselves accountable to that very goal, and hence we measure against that goal. So you'll notice in some of these periods of time, year to date, 1 year, that's June 25 through June of 24, or 3 years, that's 3 years back, or 5 years, that's 5 years back, or this all-important inception to date number. The average annual rate of return has sometimes been above the goal, sometimes below the goal. That's the volatile, the variance that you're going to see. Nobody in any investment program with any investment advisor, whether it's us or somebody else, is going to achieve exactly 6%, 6%, 6%, or 7%, 7%, or 8% every single year. There's going to be some volatility around that. Well, we've discussed that with the client, shown that to the client. The client's acceptable, they found that to be acceptable, but now we want to make sure we stay within that. And so, yeah, on one particular 5-year average was 7.21%. That's not 8%. Well, the 3-year average was 10.5. A couple of bad years in the 5 that weren't in the 3-year number. But on a long-term running basis, for all the years we've been working with this client, his goal was 8, and maybe different than your goal is, but he's achieved 8.12% per year on average, right spot on, a little bit above the goal. The important thing here is that in addition to the objectivity that we bring in putting together the whole plan, and putting together an investment plan which supports the whole plan, and then in making the recommendations, we're obviously 100% objective. That's our basis. But we also offer this predictability. We're telling the client you can earn an average annual rate of return of 8%. Not a guarantee, but that's the goal. And then the third leg of this approach is the accountability. If we've said we can earn 8 and you've agreed to earn 8 net of all fees and expenses, we should measure that. We should be able to achieve it over the long term. So the bottom line is this client has an allocation that has achieved rate of return that supports the plan. And we are on an ongoing basis not only managing that and monitoring that, but we're taking a look at what the asset allocation is because it will change over time. It just morphs as the investment markets do their thing. Some asset categories go up, other asset categories go down. You can get out of whack. So in this particular case, we make adjustments. It's called rebalancing. So we'll always be rebalancing at appropriate thresholds back to the strategic allocation to make sure that we stay on target and that we are corralling risk in the right way. So that brings you up to 2025. A long history with this client, success with this client. Client is still with us today, very, very happy. But another problem is occurring. We thought that we would get through some of the income tax issues. We did. Through some of the IRA penalty issues. We did. But now what we've got in the later years is we have a brewing problem with taxes over the long term. In any given year, you can focus on minimizing your taxes that year. But if you do that to an extreme, and if your IRAs, your 401ks start to grow too big, when you get into your required minimum distribution years, your required minimum distribution can become so large that even if you don't need the money, you're still forced to take the money out, pay the tax on that withdrawal. Yes, you can reinvest it, but you've had to withdraw more than you need. So we looked at what was called a Roth conversion strategy. The strategy is fairly simple. What it means is, if it's going to work, in any given year, we might want to purposely take out more money than we need. Yes, we're going to expose it to more income taxes in that given year than you would otherwise have to based just on required minimum distributions. But if we're doing this early enough in the cycle, take that money out, we pay the tax on it. We put it into a Roth IRA. You're allowed to do this conversion. The money now continues to grow inside the Roth, tax-free. And in later years, all years in the future, in fact, when you withdraw from a Roth, it's tax-free. So we are looking at the strategy of purposely withdrawing now in earlier years, paying an income tax that doesn't otherwise have to be paid, to put money into a growth vehicle which is tax-free now forever. Does that work? A lot of numbers on this page. What I want to do is just kind of focus you on what we've done. Essentially, the results are we're taking the required minimum distributions only as a strategy. What does that look like in terms of what will your IRA be? What would the Roth be? And then what we want to do is take a look at, well, what would happen if you take and do Roth conversions? And we want to test that growth. And in that slight orange or brown bar there that's on the page, we're looking at the relative difference. What is the cumulative net account values without the conversion over time versus what are the cumulative account values with the conversion and paying the tax. And when does this make sense? Now, we have to impose assumptions about the income tax. So you'll notice that we've got a marginal income tax starting out at 25%. Unfortunately, it gets to 41%. So we do have larger taxes in the future, which means if we have larger tax rates in the future and larger balances in the future, your tax will be tremendously, significantly larger in the future. So we tested a $200,000 conversion. You'll notice that in this first year, right here, he's underwater by 49,200. He's 49,200 worse off by doing the Roth conversion. Next year, 248,000 cumulatively worse off. Then it starts to change. Now it's only 30,000. We've started to see some benefit. Pretty soon, by the time that we get here, this is his age 80. He is $126,000 cumulatively better off after taxes by doing the Roth conversion each year. And when we get out to, and now we continue to 97, because fast forward, his kids are grown, his kids themselves are adults, they have children, so they're grandkids. So yeah, his oldest child is going to be 68. Yes, he's 97. The benefit, though, for that pool of money, and this plays to the legacy dream for people that have a legacy goal, have a legacy dream, he's now $19.7 million better off by doing the Roth conversion. This is a benefit to him if he lives long enough. But it's a tremendous benefit to the family. Not everybody chooses to do this. Depends on your unique family situation, what you want to do, who you're trying to bless, what you want to enjoy, what your tax rates are, etc. As you can see from the graph, maybe it's a little tough because it's kind of small, but in the early years, that line actually dips down a little below the zero mark. I showed you that in the numbers. There is a negative benefit. He's worse off in the first couple of years, and then it starts to grow, and then notice how this curve is really going up. It's called asymptotic. It grows geometrically, not just arithmetically. So it's not an extra 100 grand each year. It's 100 grand, then it's 120, then it's 150, then it's 200, then it's 400. I'm making up numbers, obviously, just to illustrate the point, but there is this geometric growth. In any event, what this illustrates, I think, is what the difference is in our planning process. That it is holistic, and it goes on for a lot of years, all years, and will continue to go on with the clients that want that. It's incredibly detailed, so we can be very specific about making recommendations that reflect what your goals are, what your situation is, what you want to do, and constantly monitor and make sure that you stay on track, because that ultimately is the key. If you don't stay on the plan, it's probably not worth the piece of paper that it's written on. You just stick it in a shelf somewhere and let it become kindling 10, 15, 20 years from now. You need to keep working on it, go back to it, the roadmap that I've mentioned before. Make the fine-tuning adjustments that are necessary, and what I've shown you here is a fine-tuning adjustment. We got an IRA, because of some very, very good performance from 2009 to 2025, larger than what we thought they would be, which means now we're building some tax problems in the future that we're going to start to mitigate. Anyway. Long runway. I'm sorry for having taken all this time in this video, but we wanted to be thorough in showing you what does our process look like, what does that difference look like, and whether or not that difference might apply to you. If it does, we'd love to hear from you. Please go to our website, click the Let's Start Now or Start a Conversation. We got a number of different places where you can click and request an appointment. That first introductory appointment is free of charge, and we'd love to just connect with you. Thanks for listening.